Hello there, and welcome to Building You and Your Money with Salome Rue. Thanks for joining me today as we talk about the rise of interest rates in the UK in June 2023, what that means, and how that actually impacts you, perhaps. Okay, now, if you've not subscribed to the channel, please do. And also, if you do enjoy the video, press the like button because that will enhance the viewership and it will also help me make better videos with more viewers in line. So anyway, let's talk about interest rates. What does it mean? What's going on? Why have the rates gone up? And what do we expect should happen in the future? Now, we all know about inflation, right? Inflation is simply just the measure of the average change over time of what we pay for our goods and services, right? And one of the ways to control inflation is actually to increase interest rates, okay, where inflation is high. So, for example, in the UK, the current inflation rate is at around 8.7% at the time of recording this video. You will see in some more sophisticated reports, it's considered as the consumer price index. It is purely just inflation. Okay, now why is it high? How do we know it's high in comparison to other places around Europe to start with? When you look at France and Germany, theirs is still within the 6% range. When you look at the US, it is below 4%. When you look at the wider G7 countries, the UK currently has the highest level of inflation. So that tells you a lot about what's influencing the interest rates. So when the interest rates are increased, the basis is that inflation reduces because the expectation in theory is that people will reduce their spending because they're attracted to save more money, right? Because of the higher interest rates. And when they spend less, there's a reduction in demand of goods and services, and therefore perhaps a drop in price. The other aspect is the fact that when high interest rates are introduced, it is meant to then influence the value of the pound, right? So if the pound gets stronger, it then means that we'll be able to push down prices for what we are importing, and therefore what we then sell in the UK becomes cheaper, therefore lowering inflation. Again, this is in theory, right? So currently the Bank of England has been really trying to bring down the rate of inflation to about 2%. So we're still a long way away, and therefore this interest rate increase that has been introduced by the Monetary Policy Committee, which is, by the way, a special group of 9 individuals, who I think are 9 men, that meet in a room 8 times a year to discuss what the interest rate should be, and then we get the announcement. Okay, so that's the background of that. So the interest rate has gone up from 4.5% all the way to 5%. Now, the thing that's interesting is the fact that the financial markets were expecting the increase to only be 0.25%, so perhaps from 4.5% to 4.75%, which is kind of in line with how it's been happening for the last, few couple of years, right? However, it shot all the way to 5%, which was a 0.5% increase. Now, this is interestingly the 13th increase in interest rates since 2008. And historically, in the 80s, there has been, high levels of interest rates in double-digit zones. For example, in 1980, the interest rate went as high as 17%, right? But obviously, we're talking about a different era. Things were different at the time, and the economy was different. But in more recent years, people living in the UK had been accustomed to having interest rates that are under 2%, particularly in the last 10 years. So this 5% interest rate has caused a lot of noise, and it has created a bit of a ripple effect because our lifestyles had been geared to, be sustained at general interest rates that were around 2%, right? So 5% then means it's quite a big difference and quite a big change, especially for people that will have high levels of debt, particularly within mortgages. So how does this impact you? Okay, so let's just say you have a mortgage, right? And in most times you can have a mortgage that's either fixed rate mortgage for your interest, or you have a variable rate mortgage for your interest. Now, to be fair, majority of people will fall into the category of a fixed rate mortgage, which could be fixed for 2 or 3 years or perhaps 5 years. Okay, so these interest rate increases won't impact you if you are in that category. And statistically speaking, at the moment in the UK, there is a big population of about 6.8 million people that have fixed rate mortgages. So they're pretty much not directly impacted now. However, that is only until the deal expires. So at the point at which the deal expires, there's then a review of what the interest rate is going to be, and that totally changes what they're paying back on a monthly basis. At the moment, there's about 350,000 borrowers that are ending their fixed rates in the next 3 months. So pretty much a lot of people would be concerned about this because they probably got into the mortgage when interest rates for mortgage rates were probably much lower at the 2% level thereabouts. Okay, so that's the fixed rate group. With the variable rate group, they are the ones that will see the drastic change immediately. Because if you're paying your mortgage on a variable rate, it simply means that every time the base rate interest rate changes, your mortgage rate also changes at the same time. So with the current change today, well, this week, I would say, the 0.5% increase would mean that if someone has a mortgage, let's just say it's a 20-year mortgage, and the mortgage is worth about £275,000 for their property, the amount that they're paying each month will go up by about £78 thereabouts, right? That's for the immediate increase. However, don't forget that the increases have been happening consistently, right? So if we look at the last increase in December 2021, where interest rates were only like at 0.25%, for example, right? The mortgage rates would have been much lower at the time. And what that person is now paying compared to December 2021 will be over £700 in a cumulative difference on a monthly basis. So it's a very, very big change, right? But on a month-to-month basis, or at a time that it's reviewed, it may not seem like a lot, but it is actually quite a lot of money for most people given the average property prices. So I know that's a lot of numbers I've thrown at you, but I'm just trying to give you the context that having a variable mortgage means that you will always have to pay fluctuating interest on your mortgage based on what the base rate announcement says. Okay, so if there's a drop, that's great. If it stays the same, that's all right. But these increases mean that you're having to pay more on your mortgage. Now, on the other hand, we could be having people that are looking to buy homes for the first time. Now, this is actually a very tricky time because new inflation figures have shown that there's been an uproar in the market, right? With a lot of mortgage products actually being pulled out of the market altogether, simply because the lenders themselves are not able to settle for the best deals with the previous rates that they had. So if they had lower interest rate products, they have essentially pulled some of those out of the market, leaving some of the first time buyers with a very, very limited choice. Okay, so you'll find that there's a deal where to get a 2-year fixed rate mortgage, you're probably being hit with a mortgage rate of about 6.15%. But to get a 5-year deal, you're probably having to get a fixed rate that's about 5.79%. So, it's really making a big difference in what people can do right now when it comes to the mortgage situation. If you don't have a mortgage or you're not planning to have a mortgage, you may not be as impacted right now with the interest rates, but it does impact your other lines of credit that you might have. With loans, I guess they already have their interest rate fixed, so they can't really be changed. But with credit cards, those rates can change anytime. So you just need to make sure that you are keeping an eye on any updates you might get from your credit card companies that may suggest that the level of interest you're having to repay on is higher. If that happens, there is always the option to explore 0% balance transfers. If you have a good credit rating, you may need to play around with that just to make sure you keep yourself in a zone where the payments are manageable. Now, on the bright side, the good news is for the savers, right? So if you are in a position where you are able to accumulate some savings, right now when the interest rates are high, you are at an advantage because you're able to earn more interest on your savings. Now, the key thing to be aware of is that there will be a lot of products from various banks and financial institutions that obviously want you to save money with them. And what I've noticed is that some of them in fact, majority of them come with specific terms and conditions. Like the one that's the best in the market right now is coming from First Direct, right? And they're saying they can offer a 7% interest rate on your savings with their bank account. But guess what? Their regular saver account is only provided to individuals that already or will have a current account with them. Okay. And there is also a restriction on how much you can actually save in that account and for how long. Okay. So, for example, if you're saving £300 every month, that is the actual maximum they allow. It means that per year, the threshold they'll allow you to save in that type of account is actually £3,600, which means that if you are saving at a much higher rate, you then have to have alternative savings accounts because that is the maximum that can go in that 7% interest account. So, for those that are fortunate enough to be having a very good and regimented savings rate, then I guess you can capitalize on this, right? So, what would I say in conclusion and what would I say as reminders? I know I've given you the economics lesson and I've probably thrown all these facts and figures at you, but what should you then do, right? The thing is, you still need to prioritize your sanity, your happiness, and your well being, right? Rather than being overstressed. Okay. If you are in a situation where you think you will struggle to pay your mortgage payments because of the changes to the interest rates, then the earlier you have your conversations with your mortgage providers, the better, because they are obliged to work with you. They're obliged to make sure that, there are practical solutions that are provided to you. You could have the option of going on a mortgage holiday, which essentially means that you perhaps take a break from making payments. But guess what? When you come back, you probably pay more. So you just have to obviously make sure that it's a practical solution. Or you could extend the terms of your mortgage. Again, that will not be advantageous in the long term, but to be able to tackle the situation right now, you just need to make sure that you look at the various options. There could be an interest-only approach. You need to speak to the right person to get that advice, but make sure that you explore the option that might be available to you out of those. The earlier the better, rather than waiting until you can't pay and then you're having to default on your credit rating and creating a whole mess for yourself. So the other thing I would say is don't focus on things that you can't change, right? We can only focus on the things that we can change. And this comes down to how our spending habits can be adjusted, how our life style can be adjusted, right? The rate increase might continue because there is an expectation that the rates will still go up to about 5.5% over the next couple of years, right? So we need to be prepared for that. However, a practical thing is for us to start finding creative ways of expanding our earnings, right? It's either you do that through your existing job, you do that through a side hustle, you do that through a business, because if you are expecting to maintain your earning level as it is, there is going to be so much more that is demanded out of your money and you'll have more month left than actual money, right? So, those are the practical things we can be thinking about. If you're privileged enough to be able to overpay on your mortgage, then that will be fantastic to do. However, I do appreciate that it's not everyone who can do that. But it is about exploring what is possible for you, minimizing your expenditure, and also finding ways that you can expand on your income. Okay, so I guess we'll receive another update from the Bank of England later this year, in August, thereabouts, and hopefully by then we'll be able to consolidate what that means for us, and if there's any further impact or adjustments or changes that we can make, and hopefully we'll keep educated, keep glued up. The world can be a brutal place sometimes, but guess what? These cycles come and go. And so, it is up to us to keep ourselves educated, to keep ourselves knowledgeable, and above all, to be as flexible as we can to our spending, saving, and investing. So thank you for watching, and I'll see you on the next video.